So now we're changing our focus to a merchandiser. So the first thing I want to make sure of is that you guys understand what a merchandiser does. So I'm going to define it for you because there's also manufacturers, which you cover in Accounting 102. So merchandisers are companies that buy goods and turn around and sell them in their same form. They don't create the merchandise. That would be a manufacturer. They simply buy it at wholesale and then turn around and sell it to us, the end user or the end consumer, at retail. Examples would be the stores you guys go by when you're out driving, Walmart's, Target's, 99-cent store. And even restaurants really could be considered merchandiser, but they're also kind of a part service, part merchandiser. So as we work through these merchandising chapters, I would picture one of the stores you like to frequent in your head, like a Walmart or a Target. And so whenever we start a new type of entity, we need to spend a little bit of time becoming familiarized with some new accounts. And for today, we're going to practice the selling side of the house. So I want you to think about your favorite merchandiser. And again, if we were in a classroom at Cerritos College, I'd look out the window of my classroom and there's the big orange Home Depot. So that's what I tend to lecture on, but it could be any merchandiser. And any merchandiser, I'll use Home Depot, all they do all day is they buy and they sell. They buy goods and they sell goods. They buy goods and they sell goods. So your author has taken the liberty of doing the sales side first. I think I probably would have done the buying side first because you got to buy the merchandise before you can sell it. But he chose to take the sales side first. And so that's what chapter 7 is about. So that's where we're headed. We're going to talk about the sales side of the house. And if you think about it, picture yourself inside a Target or a Walmart or a Home Depot. And if you would just sit back and you'd watch the cash register, there's 4 basic types of sales transactions and any of these merchandisers that we just mentioned. Sometimes you see cash change hands, but I don't know about you guys. I don't see a whole lot of cash changing hands anymore. So there's cash sales. The other types are sales on account, and we've done sales on account with service-oriented firms. That's where they just issue, it's called a gentleman's agreement, really, like 30 or 60 days to pay for the goods or services. And then what I see most of when I'm just looking at the cash registers, I see more credit card sales. And there's 2 types of credit card sales. There's bank credit card sales like MasterCard and Visa, or there's non-bank credit cards. Probably the most popular one is American Express and a little bit of Diners Club and Discover Card out there. So that's going to be what our focus is on today. So any questions on what a merchandiser does before we get into the accounting for it? I put the agenda up here. I want to encourage you guys as new accounting students to use agendas as a checkoff sheet for your test. In other words, do you know what a merchandising business is? Do you know what the different types of sales transactions are? Can you list, after today, can you list the new accounts? And anytime we talk about new accounts, I've tried to get you guys in the habit of showing 3 things, and we'll do those same 3 things today. The type of account, the normal balance of the account, and which financial statement it goes on. And then you'll see the real focus are those 4 different types of sales that we just got done mentioning. Of course, we're going to dive in and get our hands dirty. We're going to look at cash sales, sales on account, open account, 30-day terms usually. And then we'll look at bank issued credit cards like Visa or MasterCard. And we'll take a look then at the non-bank credit cards like American Express. And because we live in a state that has a very substantial sales tax, we'll also be taking a look at transactions that involve sales tax. So that's where we're headed. Let's grab the handout for today. And again, your author has split this into the selling side of the house and the buying side of the house. So what is a merchandising enterprise? We already mentioned that. It's somebody that buys goods and turns around and sell them in the same form. And so because we're changing our focus, there's some brand new accounts. And the very first exercise we do in here today is going to be dealing with these accounts. So let me go ahead and talk about them, and then we'll jump into the exercise and see how much we remember. So sales is the major revenue account for any type of a merchandiser. So if you think of Target or Walmart or Home Depot, they don't have fees income. They have sales. So sales now is the major revenue account that we're going to be working with. And like all revenue accounts, it has a credit balance. And like all revenue accounts, it's going to go on the income statement. Okay, so sales is going to be an account that we use with every sales transaction. And if you were to go today and look up any of these merchandisers' annual reports, they're called 10Ks, you would see that Target has sales, Home Depot has sales, car dealers have sales. That is the major revenue account. Some states, but not all states, have a sales tax. We have a very hefty one. It can range depending on what county you're in. There's a big range, but right around 10% for most of Southern California. So we want to make sure we know who pays that, right? It's the end user, the customer who pays the sales tax. So if I have a company and I'm buying something to turn around and sell to somebody else, I don't pay the sales tax. It's the end user, the ones we sell to, that pay the end sales tax. That's why sometimes if you go into a Costco or something, you'll see someone in front of you flash a resale card. That's telling Costco that we're going to turn around and sell this to somebody else. We're going to pay the sales tax. So don't charge us for the sales tax. It is a liability. Like all liabilities, it has a credit balance. We're going to use it today in just a minute. And like all liabilities, it belongs on the balance sheet. In the state of California, we pay that to the State Board of Equalization. And by the way, those of you that are thinking about starting small businesses, you do not want to mess around with sales tax. I can tell you from experience that once you have those people on your back, they're very hard to get rid of. So some students naively start businesses without knowing how the sales tax rules work. It would behoove you, if you're thinking about even a small Etsy site or some type of a site, to take a short seminar class on how the taxing works for sales tax. We're just talking about it from a 20,000 foot viewpoint. And then because we're going to be using credit cards or accepting credit cards from customers, we'll talk about a new account called credit card expense. It is an expense. Like all expenses, it has a debit balance. And like all expenses, it's going to be on the income statement. So those are some of the new accounts. If I scroll down, there are two contra sales accounts. So if I think where we've been, I know that we've talked about drawing as a contra account, and I think we've talked about accumulated depreciation. I think those are the two contra accounts that we know. So now we're going to add two more. And those of you that have been into a Target or a Walmart, which is everybody in this room probably, occasionally we need to return something. And so the retailer records that in a brand new account called sales returns and allowances. And I want to make sure you understand the difference between a return and an allowance, but the accounting is going to be the same. So one account. A return is a physical return that I make to a customer. So I have this Yeti cup because I'm drinking some coffee in front of me. So if I bought this Yeti cup from Target and it had a defect, maybe the top was cracked, and I took it back to Target, Target would record that as a sales return and allowance. They want to keep track of the returns because they're really expensive to process. And they want to see if there's some kind of a trend that they need to look into on certain merchandise. That's a return, right? Let's take the same Yeti cup with the same defect. Let's say it has a broken top. I could take it back to Target and say, guys, I bought this for full price. It has a crack in the top. And they might say, okay, go ahead and keep the cup, but we'll give you $5 back. That's an allowance where you don't physically return the good, but you offer the customer a discount because something is defective. Okay, so this is a brand new account. We're going to use it today. Because it's a contra revenue, remember what that means, contrary to the normal revenue. It has a debit balance, and it will also show up on the income statement. And then if you read the chapter, this will look familiar to you. If you didn't read the chapter, it's going to look like, I call it a funky fraction. So on invoices, you're going to see these things that kind of look like a funky fraction. And what that means is the seller is offering a 1% discount if you want to pay your bill early within 10 days. So in order to encourage people to get their cash in quickly, some sellers, actually many sellers, offer a discount for paying early. Otherwise, the whole thing's due in 30 days. When that discount is taken, it goes to this brand new contra account called sales discounts. So that's a lot of new accounts. I didn't count them, but 5, 6 new different accounts. So we're going to try our first exercise, just to kind of recap them all in the same place. And then we'll jump in and get our hands dirty with the journal entries. So let me stop for a second. Do you guys have, and somebody across the street is getting their grass cut. That's the noise you hear outside. Does anybody have any questions on any of the accounts or on anything else that we talked about?
Yeah, I have a question.
Okay.
So for the only thing that can be debited out of all these accounts is the sales tax, right?
Well, the sales returns and allowances and the sales discounts, those are debit accounts.
Oh, those are debit accounts?
Those are contra revenues.
Okay, so right, yeah.
Yeah, they're going to have a debit balance. The sales tax is credited when you make the sale because it's a liability and your debt's going up.
Yeah.
Be debited when it's paid.
Right, and also it's only partially returned, right? For that amount of money that you like return, like the amount of goods that you return, only the sales tax applies to that amount, correct? Or
on a return, you're going to get your sales tax back just on the amount that you're returning.
but what about allowance?
The allowance, if you paid sales tax, you would get your tax back.
Oh yeah?
Yep.
Okay, all right.
Yep. And if you guys ever have that happen as a consumer, I'm sure that at some point you will, you have to demand that they give you your tax back also because you paid for that full up front. So that's a good question. Anybody else have any questions before we dive in? Okay, let me share my screen. Let's go grab those Excel spreadsheets. And I added to this first exercise because I want you to know 3 things for the test. And the exercise only asked you for 2 things. They asked you for the normal balance and the type of account. So I went ahead and added a 3rd one. I also want you to know what financial statement they go on. Because all throughout your 3 semesters of accounting, you're going to be creating financial statements. And so I think that's a good thing for you to remember. If I were you, I would start a running list, if you haven't already done this, where you keep track of all the accounts we learned, and I would keep building to it in 101 and 102. So accounts receivable, we know this part isn't new, but it's an asset. And like all assets, it has a debit balance. And like all assets, it goes on the balance sheet. So that's our first one. The rest of these are new. Accounts receivable is not new, but the rest of these will be. Sales tax payable. Well, I would have you hone in on this word because we know what that word means. We know that word payable means you have a debt. And so that is a liability. It has a normal credit balance, and all liabilities go on the balance sheet. And here comes our major account for the day, the sales, the selling side of the house. We're going to be using the sales account, which is a revenue. It has a credit balance. And like all revenues, it goes on the income statement. And then we have these next 2. I'm going to highlight them because they're contra accounts. And whenever we have contra accounts, you're more likely to have problems with them because they're contrary. So this is a revenue, but it's a contra revenue. So I'm going to sneak that contra in. And if a regular revenue has a credit balance, a contra revenue would have the opposite. And like all revenues, it's going to be on the income statement. And sales discounts, remember what those are. They show up as kind of funky fractions like this. And that one there represents the sales discount. So if you were offered terms of 110 net 30, you would be offered a 1% discount if you pay it within 10 days. That's also a contra revenue that has a debit balance, and it goes on the income statement. And again, I highlighted those because the contra accounts always cause a little bit of confusion. And then credit card expense is an expense. Expenses have debit balances, and expenses go on the income statement. So the last thing I want to do before we go and we get our hands dirty with journal entries, I want to remind you that we are moving from this very short income statement that we've been used to working with, where we just had revenues less the expenses. We're working towards this huge income statement. It's called a multi-step. And the only way we're going to learn it is if we learn it in chunks. And in this chapter, this chunk on the income statement is going to be called net sales. And so I'm going to write it down here. I'm not going to bother showing you the income statement that we're working towards today because it would be completely overwhelming if I did. Just suffice it to say that we need to work hard in every chapter from here on out on remembering a chunk of the income statement. So this is what your income statement's going to look like. You're going to see sales, and then directly below it, you're going to see two things come out: the returns and allowances and the sales discounts. And let me put sales, returns, and allowances, because on the other side of the house, on the buying side of the house, there's going to be another type of return. And let me also take out the sales discounts. That is the first chunk of our income statement. And so this is what we want to focus on. I would take the time to probably write that on an index card. I happen to study with index cards when I study. And that would be something that we're going to be using a lot in the next chapter. I don't know why I'm having trouble keeping that color there. Any questions on those new accounts before we jump in and try some? Okay, well, I'm going to go open a new tab. You guys can come to the very end. There's this plus sign. You can click it and it'll open a new Excel worksheet. I think I opened mine here. Let me move it to the end. And I'm going to use this to put up an example to teach you these 4 different kinds of sales, right? So at the start of class, we looked at our agenda. We're going to do a cash sale, an on-account sale, a bank credit card sale, and a non-bank credit card sale. So I'm going to put some details up here, and then we're going to walk ourselves through the transactions. And if you can get this example down, then the rest of the chapter is going to be a piece of cake for you. So we could pick a store, or we could just use an example. Let's say that we made a $100 sale of merchandise. And just for ease of understanding, let's say that the sales tax rate is 10%. And I think that's all we need for now. So using that data, we're going to record 4 different types of sales. And if you would like to think of a company, I'm going to go ahead and put Home Depot up here just because that's what I use when I'm looking out the window. Okay, but you could use any company. And here's the 4 types of sales. I'm going to list them up here, and then we're going to demonstrate them. We're going to do a cash sale. We're going to do a sale on account. We're going to do a bank credit card sale. That would be Visa or MasterCard. And then we'll do a non-bank credit card. like American Express is the most popular one. All right, let me get rid of those decimals because I don't want that to confuse you at all. And we're gonna jump into it. So 1, cash sale. Think about being Home Depot. And if you sell merchandise for cash in Home Depot, $100 worth of merchandise, how much cash are they going to give you? Okay, well, this is what it's going to look like. We're going to get some cash, but in order to get that debit, we're going to record the sales at 100. And then don't forget, you have to collect that sales tax, because if you don't collect the sales tax, you're still responsible for it. And that is a lesson that I want small business owners to understand from the get-go. If you don't collect sales tax from your customers, you are the one that's going to be held responsible for the tax. And the way that we calculate that tax, we would take the $100 sale times the 10%, and that would give us $10 that we owe to the government when we sell the goods. And so the cash that someone would give the cashier at Home Depot would be $110. There's one of two ways to calculate that. You can either sum these two up, or a shortcut that might be easier when you're on your calculator is it's the sale amount times 1 point whatever the tax rate is. In this case, it's 1.10. That's a quick way to get the cash. So let me say that again. When my children were little, I would send my teenager to the mall, maybe with $20. And I would tell her, now make sure that whatever you buy, you got to make sure you have enough to cover the sales tax. So I think probably the rate was 8% back then, she would in her head take the sales price times 1.08 to see if she had enough money to buy the goods. So if the sales tax rate is 8%, it'd be 1.08. If the sales tax is 12%, it'd be 1.12. See how that works? That's a little bit of a shortcut mathematically. That's a cash sale. And by the way, I want you guys to notice something. In all 4 of these sales, the credits are going to remain constant. It's going to be that debit or the form of payment that changes. Okay, so now the exact same sale, but on account. Before I do that, anybody have any questions? You can just unmute yourself. Okay, so same exact sale, but this time, let's say we're a construction company, and so we just have an open account with Home Depot. Home Depot does this often. They'll run your credit and they say, okay, we'll loan you you can buy up to $20,000 worth of stuff. You have a $20,000 line of credit. So this time Home Depot sells it on account. Okay, well, the debit is going to be to accounts receivable for how much? For the sale times 1.10. Okay, so that's 110 again. Let me make this a little bit bigger so it shows up. And the credits are not changing. The credits aren't changing at all. We're still selling $100 worth of merchandise. So the sales amount is 100, and the sales tax payable is still 10%. That's not changing either. So again, credits aren't changing, only the form of payment is changing. So I should have left room to put a description for your notes. Not that important, but let me squeeze it in there. To record a cash sale. And on this second one, to record a sale on account.
Professor.
Yes.
For the accounts receivable problem.
Yeah.
That's when you would utilize the subsidiary ledger, correct?
Yes. So I'm glad you asked that question. From this day forward, I was going to teach it to you next time, but since you asked about it, from this day forward, every time we use accounts receivable now, we're also going to keep a subsidiary ledger, and that's a big fancy word for part. A subsidiary is part of a whole. That's why when we go buy a Taco Bell is a subsidiary of Yum Brands. It just means it's part of a larger company. So we will be learning about an accounts receivable subsidiary ledger. So Thamir has a really good point. If you've read the chapter, we need to follow accounts receivable now with the name of a customer. So I'm going to teach you about the accounts receivable subsidiary ledger in the second half of the lecture, which will be on Monday. So I'm glad you brought that up. You'll want to read about that subsidiary ledger. All right, so these last two are probably the more difficult. And I don't know about you guys, but I rarely see cash changing hands anymore. It's usually credit cards, debit cards, Apple iPay, and a bunch of these other things. So bank credit cards, the type you're most likely to see, a Visa or a MasterCard. So here's how that works. And a lot of students don't understand how these credit card companies work. Most students think that the vast majority of these credit card companies make the majority of their income off of the outrageous interest that they charge all of us if we keep a running balance on our credit card. Actually, the way that credit card companies make the vast majority of their income, every time you swipe that credit card, the person that you're buying it from pays a 3% fee. 3% is pretty typical. And so what happens as a business owner is I record that sale, and within 24 hours, the money's going to show up in my account, but not the whole thing, because the bank is going to get their grimy hands on the 3% fee. And so we need to understand how to record that. So I'm going to use a typical 3% fee. So let me go change my set of facts up here. On bank credit cards, we're going to assume a 3% fee. And on non-bank credit cards, it tends to be a little bit higher. We'll go ahead and use a 4% fee. So let me show you how that works. Let's do a bank credit card. If I were to pull a credit card out of my wallet right now, there would be a name of a bank. It would say Bank of America Visa, or it might say Chase MasterCard. That's a bank credit card. So remember, the credits aren't changing. So let's go ahead and get those in. Leave yourself a couple of lines to write the debit, but we know that our credit is still for $100, and we know that our sales tax payable is going to be for $10. Okay, that's not changing. What is going to be changing are these debits. And yes, there will be two of them. Okay, how do I know there's going to be two of them? Because I'm a business owner, and anytime somebody swipes the card, I'm going to be charged a 3% fee. So what does that mean for you guys as negotiators? If you're going to buy a big ticket item and you have cash, or you're going to pay with a check, you need to negotiate the price of that item down, because the companies, when they set up their selling prices, assume you're going to pay with a credit card. So if you walk in with cash and it's a large ticket item, you should be taking at least 3% off of that. And you have to talk to a manager to be able to do it. But I never buy large scale goods and pay the asking price, ever. So just keep that in mind. The company's going to save 3% right off the top if you don't use your credit card. So here's what the journal entry is going to look like. We are going to be getting some cash, but we're also going to be incurring this credit card expense. Okay, how much? Well, the credit card fee expense is 3% of the whole thing, including tax. So we're going to take 100 plus 10. That brings us up to the amount subject to the fee. So we got $110 subject to the fee, which we stated was going to be 3%. So that's going to be our debit. And again, I keep making a lot of calculations to show your notes, to give you guys a good set of notes. I need to keep widening my file here so you can see it. So do that on your calculator. 110 times 3%. That's going to be the part of the sale that the bank keeps to process that transaction. So then how much cash are you going to be left with? Well, again, here's the math. We're up to 110 now, but the bank is going to keep $3.30 for themselves. So $110 minus $3.30 would be $106.70. Okay, that is probably the most confusing entry out of the three. So I want you to take a look at that for a second. And what we just did is to record a sale using a bank credit card. That's where credit cards make the money. Every time you swipe that card, the retailer that you're buying from pays a fee to the credit card company. That's why these credit card companies are getting aggressive with points and rewards and all these other things, because they know that if you use that card, they're making money. I don't know if you guys realize that Visa is one of the Dow 30 companies. That's how big it is. And the last one, unless you have questions. If you have questions, let's get them answered.
Yeah, I have a question.
Sure.
So it's recorded as cash and not accounts receivable, just because how quickly that the cash becomes into the account of the merchandiser, correct?
Yes, within 24 hours, it'll be there.
Okay.
Yep. Now, Samir, it's a great question. With non-bank credit cards, it can take longer. 2 weeks. It used to be 4 weeks for American Express. Now it's closer to 2 weeks. So that last one that we're going to talk about is going to answer Samir's question. If you use a non-bank credit card, you don't get cash right up front. You have to wait for the money. Usually about 2 weeks is customary. I don't know about you guys, but I have noticed that fewer companies are taking American Express now. One of the Asian restaurants that we love around here, all of a sudden I put my American Express down like I usually do. And she said, "Oh, I'm sorry, we don't take American Express." I said, "Oh, really? Interesting. Why not?" I knew the answer, but I just wanted her to confirm it. Because they charge more than Visa, and it takes them 2 weeks to get their money. And this is a small family-owned company. They need their money right away. So this is what this one would look like. If we can't debit cash because the cash is not going to be in our account, what makes sense then is to use accounts receivable. And you would follow it. Samir brought up a good point. You would follow it by the name of the customer. So I'll go ahead and put American Express. Now, the author teaches this in a way that I don't agree with. So I'm going to use his presentation to be consistent. He would put the whole $110 into accounts receivable. Okay, again, the credits are the same regardless of how it's being paid for. So let me go back up and I'll tell you why I have a difference of opinion with one of your authors who's also a good friend of mine. Here's my disagreement with him, and then we'll talk about how it would be resolved. My disagreement with him is GAAP says you have to record revenues and the related expenses in the same period. Okay, if I accept an American Express card, I've incurred a fee without a doubt. So my disagreement with him is I would have recorded the fee now. The way that he's going to present it to you is this. In the follow-up, so let's say 2 weeks later, when that money finally comes in, that's when he's going to record the fee. So I'm going to put in 2 weeks later, which is typical. When that money comes in, here's where you record that fee. You would have cash and you would have a credit card fee expense. And of course, the credit is going to be to accounts receivable because you're finally receiving the money that's owed to you. So let me show you what that would look like. So remember that American Express or non-bank cards charge more. We assumed 4% up top. So 110 times 4% would be $4.40 if you do the math. That means the cash is going to be 110 times the rest of it. I'll have to do that. I can't do that in my head. 110 times 96. That's why people are not accepting American Express as much. That might not look like a big difference to you, but if you add a few zeros onto it, you know, when you have decent sized sales, that can add up to a lot. So my disagreement with the author is I believe he should record the fee at the time the sale is made. He defers it by a couple weeks and he when we talk about it, he just said, oh, we just make an adjusting entry for that amount. So one way or the other, it'll get in the books. That is half the chapter. So again, any merchandiser that you can think of do two things. They buy and they sell. The author decided to show you the sales side of the house first. And with that, he's going to introduce the concept of the subsidiary ledger, which I'm going to cover next time. So that's the lecture on the 4 types of sales. Now we're going to jump in and get our hands dirty. So any questions? Let me, before I take your questions, let me put some descriptions down for your notes. So this is to record a sale using a non-bank credit card. And then this would be to record the receipt of cash weeks later from the non-bank credit card.
I have a question.
Sure.
So when it's recorded into the general journal, number 3 is recorded as that, right? It's not recorded any other way because we're gonna expect that money sooner. And then number 4 is recorded in that way. The author records it in that way so that the adjusting entry for the fee expense can be made later when we receive the actual liquid cash.
Exactly. That's perfect. Perfect.
Okay, thank you.
Exactly what's happening. You're welcome. Okay, let's go try some. So going back here, I'm going to try a little bit more difficult one than those in the interest of time. Let's go to 7-4. This one kind of combines what we've been talking about. Exercise 7-4, couple tabs over from the beginning. So this is a state that has a sales tax. And by the way, all states do not have sales tax. So this is a state that has a sales tax and there's going to be some returns thrown in. That's the reason I wanted to do this, to demonstrate how a return would be recorded. So April 2nd, let me date this. And so that Excel doesn't throw me into a formula, I'm going to press the space bar before I type in April. So April 2nd, it says sold merchandise for cash, $3,500 plus sales tax. Okay, so there's going to be 3 accounts. We just went over an example of this. We're going to use cash, we're going to use sales, and we're going to use sales tax payable. So a quick way to get the cash, we did this earlier too, a quick way to get the cash would be to take the amount of the sale and multiply it by 1.08. Okay, why 1.08? 8% sales tax. So let me do that on my calculator or Excel. 3,500 times 1.08 is going to give us the cash that we would record for the sale, or that we would record as the cash received. The sale is always at the amount of the sale, 3,500. And the sales tax, if you want to put that calculation, you can widen it a little bit to fit that in there. Sales tax payable would be the 3,500 times the 8%. Thank goodness you guys can use calculators on the test. And that is to record a cash sale with tax. Okay, next day, the customer that bought that stuff returned $500 of it. Okay, we had this question brought up earlier. If you've paid cash for something, the company legally has to give you cash back if you can provide a receipt for that. So none of this, I know when I was younger, or I've even seen my kids be taken advantage of, you know, if they see a teenager come in to return something, they want to give them store credit, right? If you've paid cash, they need to give you cash back. And if they won't, and you have the receipt, you need to ask for the manager because they need to do that. So remember what we're doing now. We are recording a return. Okay, so that means two things. A lot of people see that and they say to themselves, well, if you credited sales, just debit sales to like reverse it out. No, a company wants to track their returns. That's why we have that special account. Sales, returns, and allowances is going to get debited just for the goods returned, which is 500. We have to give them their sales tax back. And so we're going to debit sales tax payable for that 8%. So go ahead and calculate that either on a calculator. Some of you can do it in your head. Having trouble getting to the end of that there. 500 times 0.8%. I'll let the computer do that so I don't have a slide error. So I got $40. That means you need to return to the customer $540 worth of cash. So let me stop for a second. That's the first time we've really seen that sales, returns, and allowance contra account used. So make sure that you understand that. And if not, by all means, ask a question. So we just recorded to record a sales return with tax refunded. Okay, if I don't hear questions, we'll go try the next one. If I do have questions, I don't want to rush it. So if you do have questions, ask away.
I have a question.
Sure.
What happens to the expense if a credit card is used?
So if a credit card was used, we would have, well, the bank's still going to charge us for running that transaction. So yeah, really nothing. Now, if you do a lot of volume, you could probably make an adjustment or call up the credit card company, but the credit card company looks at it as, look, we're not the ones that sold the defective merchandise. We still had to process the amount. So that fee's not going to be refunded. It's a really good question. You don't often see that refunded.
So it would just be sales returns and allowances and the sales tax and then the cash, right?
Yeah.
Okay, it'd be the same. Okay, thank you. I appreciate it.
You're welcome. All right, then on the 4th, sold merchandise on credit. So there's a keyword. We know what that means. That means on account. So what's going to change is we're not going to use a debit of cash anymore. We're going to use a debit of accounts receivable. And to get us into the habit of writing down the last name of the person because of that subsidiary situation that I'm going to teach you about next time, let's go ahead and write Dang. Her last name is Dang down. And of course, the credit's not changing. Sales and sales tax payable whenever we make sales in a state that has a sales tax. So here, I'm just going to use the shortcut. I'm going to take 175 times 1.08 to get my debit to accounts receivable. I got 189 when I did that. Oh, I think I'm looking at the wrong one. I'm looking at the one below. My bad.
Yeah, I was about to say.
Yeah, so thanks. You guys keep me on my toes there. I was looking at this one instead of this one. So let's try it again. 1,025, that looks better, times 1.08. And you should be calculating them as well. Definitely, if you see a mistake, point it out for sure. And then the sale would be recorded at 1,025, and the tax would be recorded at 8%. So I'll go ahead and do that. Always with these compound entries, take an extra moment to make sure that your debits equal your credits, especially on a test. Always go back and check, especially somebody like me that transposes numbers. So to record a sale on account is what we just did. It would also be a good idea to put in the source documents, any kind of invoice number or check number, and terms of payment. What that N30 means is the net is due in 30 days. They're not offering any kind of quick payment, just net 30. All right, and then April 6th, accepted a return from that person, right? But this time they didn't pay cash. So you're not going to give them cash back. You're going to decrease their accounts receivable, which is where this term credit memo comes in. So this lady that just bought something, Lisa Dang, returned some of it, not all of it, but some of it. She returned $175 worth. Well, this is how a return looks. We're still going to use that contra account, sales, returns, and allowances. Put her name in because we're going to be keeping track of that shortly. And that would be for the amount returned. That's where that 175 came from last time. We have to give her her sales tax back because she returned it. So 175 times 8%. We'll go ahead and calculate that. And we're going to credit her accounts receivable. Why? Because if she returns something, we do not expect her to pay for it. So you could just add those two up, or you could take the shortcut and take 175 times 1.08 to record the return of goods by a credit customer. You would definitely want to list a source document. Source document is something you could trace a transaction back to. And I think if we go look up above, they gave us a credit memo 302. Issued. And then finally, what's going to wrap this up is we got to receive the cash from her. I'm sure that's going to be the last item. I'm going to go scroll up here. Recorded payment on account and payment of that purchase less the return. Okay, here's what I would encourage you guys to do. I would make a T account, especially because I know what's around the corner. I would get into the habit of making a quick T account. This would be for accounts receivable, especially when these discounts start coming into play. So for accounts receivable for Dang, if I take a look at what's in there, we had that sale on April 4th, including everything, was 1107. And then we had that return. Thought I put a line in there, apparently not. And then we had that return here for 189. And that was on April 6th. So again, I know what's around the bend. If you compute what's owed before any kind of discounts, now this one doesn't offer a discount, but they will in the future, that will keep you from making mistakes, silly mistakes. So I'm staring at this, and when I foot that T account, she owes me now $918. So when she pays that, when she forks that amount over, my journal entry, I didn't get the date, the 30th. On April 30th, we'll increase our cash and we'll credit the accounts receivable from Dang. I'm staring at it in my T account, so I know I'm not making any kind of mistakes. There was no prompt payment discount offered. Remember, the terms on this was net 30. That means no discount. And that is to record the receipt of payment in full. If they gave you any kind of check numbers, you would want to definitely record those source documents in here. Any questions on that?
I have one. I'm sorry, I'm asking so many, but
Never too many.
so if there was a discount, it would be recorded under accounts receivable along with the debits, correct?
So if there was a discount, we would be using the sales discount amounts.
Right, yeah, right.
And we would split it up between the cash and the sales discount.
Okay, so it's recorded when you receive the cash on account.
Right, because we don't know whether they're going to take the discount or not. It depends what their
Right.
cash situation looks like.
Right, right. So it's not predetermined before.
Right.
Okay, all right. Yeah.
Any other questions? Those are all good questions. Okay, let's go take a look. Yes, let's go do a credit card transactions because in my experience, that's the hardest for students. So right next door to it, we'll do 7-5 unless I took that screen away too fast. If I took that screen away, holler. Okay, so this one has sales tax of 8%, as well as looks like we're going to get into some credit card amounts. So again, what should we be thinking in our head? When I see credit card transactions, I ask myself, is it a bank credit card, Visa or MasterCard? You're going to get cash right now. Or is it a non-bank credit card, in which case I need to use accounts receivable? So if I were to sell something right now in my business, the cash would be there by the end of the day, within 24 hours. Usually by midnight, it's posted. So that means cash right away. So this one said, sold merchandise 4,800 plus tax to customers using bank credit cards. That means MasterCard or Visa. Record the 2% discount on credit cards at the time of sale. Okay. So what's this one going to look like? Think back to that first example we did. I'm going to put the bones, or what I call the shell of the transaction in, and then we'll go fill out the appropriate amount. So here's the bones: cash and credit card expense, 2 debits, and sales tax payable to record all of the sales that have sales tax look like that. So the sale was 4,800. The tax was 8%. So I'll go ahead and calculate that. And I hope somebody's calculating them with me, especially because I don't have a tutor in the room like I normally do. So now we got to split that amount up. We're going to get 98% because the bank's going to get their grimy hands on 2% of it. Okay, so we need to split it up. Probably the easiest way is to do the credit card expense first. So for your notes, we take 4,800 plus 384. Let me type, oops, I have an extra 0. Let me get rid of that. I'm trying to find my calculator at the same time. So 4,800 plus 384. So now we're up to 5,184. 5,184. The credit card company is going to get 2%. Okay, so we're going to take that 5,184 and we're going to split it between the bank and us. So go ahead and do that on your calculator. 5,184 times 2%. And the rest of it is going to the company. So same calculation, I'm going to shortcut it and put that 5,184 times the rest of it, times the 98%. And then double check yourself. Make sure that the sum of your debits equals the sum of your credits. Once you record these entries, that will help prevent a lot of mistakes. Okay, so that is to record a sale with a bank credit card. That means cash now. And then on February 15th, here comes the non-bank. So when you see American Express, that is the most common non-bank credit card. So let me put the bones in. Accounts receivable is used when a non-bank credit card is used. So accounts receivable from American Express, no fee now, even though I disagree with how the author is showing this to you. I'm using his method. Sales and sales tax payable. Okay, 2650, 8%. And then the sum of that, if you want to add them up, think that's what you'll get. And then it usually takes a week or two for American Express checks to come in. In this case, it's only 5 days later. So within 5 days, they have their cash, but they charge higher. They charge 3%. So again, let me put the bones in. Cash, credit card expense. And of course, when they remit the amount to us, we need to take that accounts receivable off of our books. So let me show you where I get the amount from by putting some color on there. We got to split that up. They gave us the percent. If Bank of America is taking 3%, I'll just write that here, 3%. That means that we're going to get 97%. And Excel doesn't like the fact that I put a minus sign. Okay, so we can go ahead and split that out. 2862 times 3%. The rest would go to us. You could also subtract them. There's always more than one way to do this. You would put to make sure that your compound entry balances, and you would be done. Let me make that color so you can see where it comes from. We're on the sales side of the house. We've changed our topics from service-oriented businesses to merchandisers. A merchandiser is someone that buys and sells us goods in the same form. We took a look at a bunch of new accounts. So already we have increased our vocabulary. We learned all these different accounts. We learned the types, where they go. We talked about 4 different types of sales, and we've been practicing those. We had some returns thrown in. We said that the place you're most likely to make a mistake here are on the transactions involving credit cards, because they're a little bit different. That brings us up to current. Haven't learned about the subsidiary ledger yet. I want you guys to read about that. I don't want to say over the break, but maybe in the next day or two, get the chapter read so that when you come back from spring break, we can get busy talking about the subsidiary ledger. There's one more topic I want to talk to you about today. It's called trade discounts. Does anybody have any questions on those journal entries? Okay, let's talk about what a trade discount is. And this still confuses some of my 102 students, got confused on this in a transaction we were working on. A trade discount is completely different from a prompt payment discount. A trade discount is volume based. Let me describe why we need trade discounts. Let's take a typical student. You guys, when you go to Staples, you might spend, I don't know, 50 to 100 bucks in a year on school supplies. You're considered small potatoes when you walk into a Staples. You're going to pay list price. Somebody else that has a small business might be considered, I'm going to do more revenue with them because I have a small business. So instead of doing a separate catalog for me, they'll just give me a volume discount, a trade discount. They'll tell me, you know what, you can have 20% off our list price because we know you're going to do more business. And then you get a mega user, somebody like Cerritos College, which probably spends $1 million on supplies campus-wide for everybody that needs the supplies. They're going to get like a 40% discount because they are a big user. So trade discounts are based on the volume of business that you do. Here's the deal. Trade discounts are not recorded in a separate account. The rule is record the sale at the net. And I'm going to give you an example of that on our homework. So trade discounts, what are they? They're volume-based discounts. They're single trade discounts, like an example would be 20. And there's what we call buy level. Buy means two. A buy level discount would say, not only are we going to give you the 20%, we're going to give you another 10% off. So it's 20 and 10. Now, most people, when they see that, they say, oh, 30% off. That's not what it means. It means take the 20% off first and get the net, and then take the additional amount out. And I think it's best described by just jumping in and getting our hands dirty. So let's go to the last tab here, which is 7-7. And we're going to take a look at a trade discount. You guys have been paying attention for an hour. I know your brains are tired, but I do want to cover this concept. So again, these are volume based. And the rule is record at the net. Okay, remember what net means. Think about your paycheck. Net means after deductions. Your net pay is what you take home after deductions are taken out. So I'm going to at least do the first one here. It says, and if you hear me laugh throughout these chapters, the author thought it would be funny to put all the different instructors in this chapter, in the next couple chapters. So all these accounting teachers, here's my name, are going to be in this chapter. So I still laugh when I read these. So Johnson Distributors, a wholesale firm. Okay, stop. Wholesale means we're going to turn around and sell it to somebody else. There's not going to be any tax. So they're just, let's put the tax out of the way. It's wholesale firm. Made sales using the following list prices. That's the price that you and I would see walking into the store. And trade discounts. Here's the question. What amount should be recorded for each sale? Okay, number one, we're going to do. The list is 7. And the trade discounts, this is a buy level discount. The trade discounts are 35 and 10. Well, the normal person would look at that and say, oh, that's a 45% discount. It's not. So let's calculate it. So here's the list price, 7,000. And we're going to do the first discount, which is 35%. Okay, so on your calculator, you could do it this way. 7,000 times, oh, that's hard to see. 35%. I don't know why that's so small. Let me go fix that. That's interesting. Try it one more time. There we go. So the net after the first discount, if I take the difference, now I'm down to this, but they're going to give me a second discount of 10%, not off the top, not off the 7,000, but off of this 45.50. So here's the 35% discount, and now we're going to do the 10%. But the 10%, here's where most students make a mistake, not off the top, but off of the first net. So let me go put that in, 45.50 times 10%. And the net, that means the net at the very end is 4,095. That's the amount that sale would be recorded at. So they didn't tell us to make journal entries. I'm going to make the journal entry so you can see how to record the sale. It would be, if this were on account, a debit to accounts receivable with the name of the customer. I'm just going to put Mr. Customer. And a credit to sales at the net amount, 4,095. Any questions on that?
So no sales discount is going to be recorded. It's just taken off without recording it in the general journal.
Yes, you got it. So rule is record at the net amount. It's not a sales discount. A sales discount would be offered for prompt payment. This is what we call a volume-based discount. It's for different levels of customers. It used to be, you guys are too young to remember this, it used to be that places like Office Depot would do like 3 catalogs. One that they would mail out to the students, one that they would give their businesses, mid-level businesses, and another one for the super users. Like I think Cerritos College, I want to say they get like 50% off what they buy at Staples because they spend so much money there. So I want you guys to try this second one real quick. I set it up for you. You try this second one and we'll compare answers. I'll give you a couple minutes to do it.